Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
Welcome back to the Market Insights Show. This is Kevin Prins. I'm sitting in for Erin Allen this week as she's on vacation. And I'm really pleased we get to come back each week with some new insights to the overall market itself. And this week, the topic, something very interesting. We heard from investors out there saying, tell us more about inflation. And that's what our focus this week is on inflation. And I have some amazing guests that I'm going to introduce you in 1 second. But before I introduce you to the guests, let's get through some disclosures. If you've been to this webinar in the past, you certainly know that we don't provide specific advice, nor do we provide specific recommendations. That's not what we're about. What we're here to do is provide you some general insights to the overall market and bring in some quality guests where you get those additional insights specifically. Now, talking about guests, let me introduce our guests today. Alfred Lee, one of our portfolio managers from BMO ETFs. Alfred, you've been on more than a few times. Thank you for your ongoing support. Jennifer Lee joins us as a senior economist from our BMO Capital Markets team. She's also a managing director there. Jennifer, you've been on in the past yourself, but I'm really appreciate you took the time to join us one more time, especially in the busy week you had this week. And then last but not least, we have Charlie Stanton join us at the end. He's going to outline some offers that BMO InvestorLine would like to share with you. With that, let's get into the overall topic today. First and foremost, if you're joining us through YouTube, and we have a YouTube channel, if you're joining us there, let me advocate that you hit the old subscribe button and get an update from us on a regular basis when the new content is available. And then let me also kick off and say some interesting insights in the marketplace, specifically our 2-minute update. What do we see what's going on in the marketplace? Well, we've now crossed into the new months. We can talk about the flows and see the report in the flows. Interesting, the media itself has been reporting that there were some negative outflows in ETFs this month, which is kind of a first for quite a while to see negative outflows in ETFs. But I want to put you some context around that. If you looked at the flows themselves, what you would have saw was some large institutional outflows. So if you think about the, kind of a funds, the ETF context, one thing mutual funds tend to have is kind of the institutional audience that ETFs have. And so when I look at it in this context, I say, well, that's an interesting part of the marketplace because you're seeing that our end investors are also accessing the exact same investments as institutions, and institutions are participating. Yes, they'll come and go. Maybe that creates some noise in the marketplace, but I like the fact it democratizes the investment strategies for people out there, so you're accessing that very same tool. Then moving from the market, because our topic today is around inflation, we want to provide you a tool for maybe to do your own inflation. Now, Jennifer and Alfred are going to dive really into detail about the inflation, the calculations of inflation. But let's say you want to do your own personal calculation of inflation. And really, if you think about it, the overall number for inflation is a collection of specific stats. But if you want to know what your individual inflation is, you can go to a website, and I'm just going to tell you to Google the personal inflation calculator. It's out by the Statistics Canada, and it'll allow you to put in the key items that you're spending money on, part of your overall budget, and then it'll generate for your own personal inflation. Kind of a benchmark to see what it means to you relative to the headline news you're hearing in the media on a regular basis. All right, with that, let's get into the core content. I'm going to tap Alfred. Alfred, give us a little bit of insight about what is in the 8 major parts of the consumer price index. And that's when we talk about CPI, which is how we measure inflation, please.
Sure. So I'll start off by saying that CPI essentially is the most widely accepted measure of inflation. So CPI in Canada is put together by StatsCan. In the US, it's the Bureau of Labor Statistics. So essentially, it's made up of 8 different categories, from housing to foods and beverages, medical care, transportation, and everything you see in this chart. But the good thing is that over time, StatsCan will dynamically readjust this or recalibrate it to reflect the typical household and what they're buying in terms of goods and services. So what it's designed to do is designed to essentially represent a typical household and what they're going to be spending on on any given day. So the good thing about CPI is that you could take CPI and kind of track it over time to see how it's going to move. So whether inflation is going up or down. Another good thing is that there's a CPI for Canada, there's a CPI for US and other countries as well. So you could compare CPI in Canada versus other countries as well. There are some drawbacks, obviously. CPI, I would say, is more of a backward-looking measure. There are some concerns in terms of whether that basket is appropriately put together at times. Sometimes it may represent household in certain parts of the country, but maybe not another country. But the main drawback is that it's a backward-looking measure. It doesn't anticipate or tell you what the market is anticipating in terms of inflation.
Thanks for that, Alfred. I want to stay with you for a bit more because, I mean, that certainly is something we hear on a regular basis, CPI, Consumer Price Index, and the calculation behind the 8 components there. But there's an alternative approach too, and I think, we use in the industry called break-even rate. Can you talk to us a bit about that too, please?
Sure. So break-even rate is essentially what I would say is a forward-looking measure. So we talked about, the CPI being more of a backward-looking measure. The break-even rate is essentially the market's expectations for inflation going forward. So what it is essentially the difference between the yield on a Treasury inflation-protected security or real return bond in Canada minus the difference on a plain vanilla nominal bond. So that difference in yield is essentially what the market is pricing in for inflation. So it is theoretically, because it's set by bond traders, bond investors, because there's money on the line, it's going to be potentially more accurate. But the main thing is that it's more forward-looking. So it's what the market is pricing in for inflation going forward. The good thing about break-evens is that there's break-evens across the entire term structure. So there's a 1-year break-even, 2-year break-even, all the way to 30-year break-even. So it does give you what the market is pricing in terms of forward-looking inflation. So I would say this is more of an implied inflation, whereas CPI is more of a realized inflation, more backward-looking.
Oh, that's very insightful. I'm not sure many people know about the break-even rate like you do, of course, but I'm glad you shared that insight with us. Now, let me turn it over to Jennifer. Now, Jennifer, I know you've had an incredible week. You had the Bank of Canada come up with a historic news this week, as well as you, of course, have the Fed announcement. The CPI announcements in the States. Maybe you could talk to us a bit about the calculation behind these numbers that are being shared in the media on a regular basis and how that's derived, please.
So, first of all, hi there. Thanks for having me on today. So, there's a list here that you're looking at right now that sort of feeds into what has been driving all these inflation numbers that we keep reading about in the media, and we keep hearing about, what we keep personally experiencing. And there have been so many drivers. I'm just going to walk you through maybe chronologically all the factors that you're looking at. How did we get to this stage? So first of all, we had, if you can remember all the way back, trade wars from the previous US administration. That kind of started causing some shortages of goods. And of course, shortly after that, the pandemic hit, and that produced a lot of pent-up demand during the lockdowns, and people managed to keep spending while they were working from home. And so they're ordering a lot of goods, and that caught a lot of businesses off guard. And these are businesses who had laid off a lot of their workers because they had no idea how long this was going to last for, this pandemic. So they were very short-staffed. So that caused a big increase in goods pricing. And that prompted a lot of supply issues to follow. And semiconductors were the biggest headline-grabbing item, because you can find computer chips everywhere in your house, from your phone to your computer monitors to your cars, everywhere, and even your refrigerator. So that was, and then of course you had all the fiscal stimulus, which really was very loose fiscal policy, and that added to demand. And of course, the war in Ukraine started earlier this year, and that put a lot of pressure on energy prices and food prices. And then China locked down in some various big cities, and voila, soaring inflation.
Yeah, there's a lot behind it, and I really appreciate you take the opportunity to actually break it down, but also the implications of each one of those as you drive through it. And Again, I know you have your eyes on this on a regular basis. Hey, let's talk a little bit and get you a little bit of your crystal ball out here. Now, Alfred talked a little bit about break-even rates, but I know that BMO Capital Markets and BMO Economics, of course, does their ongoing homework, kind of do projections around that. So maybe give your thoughts on a go forward around inflation based on the information you have today, of course.
So there are two questions that we have been asked a lot of recently, and one of them is, has inflation peaked? And I'm going to cut to the chase and say we don't think it has peaked just yet. I would love to say that it has, but it hasn't. And I think it will. We're looking for roughly September-ish, maybe the third quarter of this year, that we're expecting inflation in both Canada and the US to peak. This is if the Fed and the Bank of Canada's rate hikes have any say in the matter. Now, inflation risks still remain tilted to the upside. Even though we're expecting them to peak, there is still some upside risk, even with our above consensus view. You know, the latest reports that we had for June for the US, we still have only May for Canada, but both of them showed an acceleration in both the headline and the core measures, which is not a good thing. So the annual rates in the US are now expected to peak a little bit above 9%, and above 8% in Canada this summer, before declining slowly to around 3% by the end of next year. Still above the 2% target, but at least we're backing away from these 8 or 9% levels. We've got wage growth still heating up over 5% year over year in both countries. Energy and food costs so far have shown very few signs of fading. And of course, you've got the high cost of owning a house, and that has pushed rents higher. And then, of course, you've got falling lumber and metal prices. And that's a start, but, we still obviously need more. And it's not just Canada and US, by the way. It's almost everywhere around the world, maybe except for Japan. But Europe, for example, they have a greater exposure to energy, to that surge in energy. So that might take them a little later to peak, maybe sometime in the fourth quarter of this year, around 8 or 9%. The UK, I want to point out, is a standout and not in a good way. They are a big energy importer, and that has been actually a huge factor hitting everyone's pocketbooks over there. And the Bank of England is actually looking for inflation to peak much later than the rest of the major economies. They're looking for about 11% inflation in the fall. I'm going to say that again for shock effect, 11%, which is kind of crazy, but it's just because their energy regulator resets the prices for their gas prices twice a year. They did it in April, and they're going to do it in October. And so you're going to see another big jump in gas prices. So with inflation rates like that, don't be shocked to see, the UK experiencing a brief recession later on this year, if not already. And in Germany, especially with this sudden impetus to move away from Russian energy, good thing in the long run, maybe not so much in the short run, but don't be shocked to see a recession there as well.
There are some big numbers coming up, and I am glad to see there might hopefully potentially is a trend going down from here. And just for the listeners out there, or the watchers of the show, of course, if you want access to this research, no problem. Just take a look at the BMO Economics website itself. This is off their public website to give you that chance to keep a track going forward, what the projections are to help you out going forward. Jennifer, let me stay with you a bit more, if you don't mind, because one thing you mentioned a second ago was CPI, and then you said core CPI. Let's talk to the audience about maybe the differences between the two, and then maybe how that's impacting. Is it home prices, is it rents? Give us some insights there, please.
So headline CPI is what gets all the media attention all the time, like the 9.1% that we saw for the US in June, 7.7 for Canada. But even though those are the headline, the ones that grab all the headlines, it's been really driven a lot by energy. It's been the biggest driver, as has food. So we tried to remove those volatile components, food and energy. And yes, I know people always complain, why do we have to remove, food and energy from the CPI? Because that's part of our basket. But because it's the most volatile, and the Bank of Canada and the Fed, they want to get a better grip on what the underlying price trends are. And as you can see from this chart, it's not looking very good. Various measures of core CPI, they call it the core trim, and the CPI median, and the CPI common. They basically strip out or filter out the more extreme measures of inflation, and they are all pointing north. So basically the main takeaway to this is that inflation is spreading much more broadly, and there's a clear risk of it becoming more entrenched.
Okay. Yeah, spreading widely. I can see how it kind of cascades in there from the core into the broader CPI. let's talk about this a little bit more because, you know, there are certain parts of the market, bear with me, I jumped ahead there. When you're looking at the statistics and how it's being calculated and the Bank of Canada is looking at it, they're looking at a number of different things, business outlook surveys, and maybe talk to us a bit about, you know, what the announcements this week, what they're thinking about, how they're working to try to tame that inflation, and then how these business metric and outlooks are used to kind of gauge that effort, please.
So I think the bank obviously the bank has been looking at all these different surveys out there. Now what you're looking at right now is the Bank of Canada's own business outlook survey of businesses, and I think that probably helped the governing council decide on that 100 basis point hike on July 13th. Now for those in this particular survey, in the most recent one, a record high, and this is what you're looking at, 78% of respondents are expecting inflation to remain over 3% over the next couple of years, which is like, ugh, to me. That's extremely, extremely high, even though long-term inflation expectations are kind of stable at around 2.6%. But I think this is what the bank, or any central bank for that matter, you know, this is what they don't want to see. They don't want people to think that inflation is going to stay really high for a long time, and they need to bring expectations back down to the 2% target. And so far, raising rates is the only way to do that. And by the way, so that was out a couple of weeks ago, I think, and there was another survey that was out at the same time, also from the Bank of Canada, and it's called the Survey of Consumer Expectations, and it was for the second quarter. And it also reflected a lot of concerns about broad-based inflation pressures. We had inflation and expectations rising across the board, and they actually hit record highs on almost all of the time horizons. And the long-term expectations one was the one that was most worrying. And this is what the bank doesn't want. They don't want these long-term expectations to become unanchored from that target. And it's still a little bit below the record high, but it's still extremely, extremely elevated. So when consumers think that inflation is going to be more pervasive, you know, and driven by all these different factors, and they could actually start bringing in, you know, future spending that they were planning to do, you know, in a year's time. They might spend it now in the event that inflation remains high, and that's going to cause more upward pressure on inflation. This is what the bank doesn't want, hence the big increase in rates.
It was certainly a big increase this week. So, you know, what's the current thoughts out there? You know, can they actually tame this inflation war going forward? Let's call it that.
Well, the hope is that something as big as a 100 basis point rate hike is going to do it, and it certainly shocked markets. Now, we at BMO, we're actually calling for a 75 basis point rate hike for this particular meeting, and that was already above consensus. So even we were caught off guard by this. But even during the press conference that followed with Governor Macklem, he was talking about inflation expectations and making sure that they do not become, you know, unhinged, I guess. And he's also worrying about seeing a wage price spiral. Although he said we're not seeing it yet, this is something we don't want to see. And by raising rates now, front loading all these rate hikes, this is a way of cooling demand and making sure that we do not see a wage price spiral.
Yeah, and telegraphing that they're very serious about it. They are doing a good job of doing that. Thanks very much for that, Jennifer. Now, let me just talk about, you know, as that cascades into investments, and let me start with you and bring Alfred in afterwards. You know, what does that mean towards fixed income investments, this persistent inflation, and maybe the impact towards bonds? Can you give us some thoughts on that?
So the more the market perceives that the central banks, either the Fed or the Bank of Canada, the more the market perceives how aggressive they're going to be. You know, that's obviously driving rates a lot higher. And when you hear this hawkish commentary, this is when you're seeing, you know, 10-year yields, you know, hitting, you know, popping back above 3% right now, for example. It's just hovering around the 3% mark. But as soon as you start, there's perhaps a perception that the bank or the Fed could be going too far or too fast, and recession fears are starting to follow. That's what's happening now. You're going to start seeing some pullback in yields, you know, and of course at the same time you're going to start seeing pullback in equity markets, which we're looking at right now. So it's all going to be on perception of how credible the banks are and how, you know, how much everyone believes that they're going to follow through with what they say.
Now, Alfred, let me bring you into this then. You're certainly hearing that, you know, bonds could be impacted, as well as you've heard that, certainly heard equities are being impacted today. Alfred, talk to us about, you know, what we're seeing in this slide here, because we're looking at 5-year bonds, and they would be of course, rate sensitive relative to the short-term rates moving. Talk to us about this, and maybe talk to us also about maybe the yield curve too, and maybe first define what a yield curve is and what the impacts across the yield curve could be.
Sure. So the yield curve is essentially, if you were to plot bond yields for various maturities across the various curve, and if you were to line them up, you get that essentially that term structure of yield. So that's essentially the yield curve. As we've talked about in previous webinars, the yield curve could tell you a lot just in terms of how it's moving, the shape of the yield curve, just in terms of the market's expectation, in terms of what they view of the economy going forward. So we've seen the yield curve shift quite a bit over the last couple of months. Obviously we've seen a parallel shift at the beginning, but now we're seeing at the back end, yields are starting to come down, especially between that 20 and 30 yield mark. So I think what the market is pricing in at this point is the yield curve is pricing that eventually inflation will be brought under control, and then that inversion of the yield curve at the back end is essentially signaling for recession at this point. But from a bond perspective, if you're a bond investor, obviously inflation is detrimental for fixed income for a number of reasons. So the primary concern is that obviously fixed income by definition, you are getting a fixed income. So if you invest $100,000 today in a bond that matures in 10 years, if you get persistent inflation, that inflation is going to erode your value of that investment over time. And it's going to have an effect on the coupon rate as well. So that's a primary effect. The secondary effect is obviously, central banks that we've been seeing over the last couple of months, they'll try to combat inflation by raising interest rates. We've seen them do things like quantitative easing as well, or quantitative tightening this time around. So what that does is, it causes yields to go up, and as yields go up, that obviously has a negative effect on bonds.
Yeah, I mean that's a challenge when people think about what's the impacts on the marketplace we see across the board. And you're right, definitely important to take a look at the yield curve, because it's not that it just impacts the short-term rates, it impacts different parts of the yield curve in different ways based upon those expectations, as brought up before. What's the market going to be like going forward? What type of markets we're moving into? Thanks for that, Alfred. Let me stay with you now, Alfred, if we can, because certainly we're laying out the concept here of inflation being persistent for a while, certainly hopefully trending down after this, but certainly having some impacts out there. Talk to us about maybe some different kind of solution sets out there. Let's start, for example, on that fixed income side. And I know ETF providers like us, of course, have been active in the marketplace, bringing out different solutions for investors out there. Talk to us about those and talk about some of the key considerations at looking at these type of investments, please.
So TIPS and real return bonds, obviously in the last couple of months, been getting a lot of traction, especially, we've launched a TIPS ETF. That's been, one of our most popular ETFs over the last year and a half. But the way you use TIPS, or the key metric that you should be looking at, is the break-even rate, which we talked about earlier. So the break-even rate, just as a reminder, is the difference between the yield on a Treasury inflation protected security or real return bond in Canada minus the difference of the yield of a plain vanilla bond. So the way to use the break-even rate and to apply it to TIPS or real return bond is basically, if you think inflation is going to come in higher than that break-even rate, that means you're better off owning the TIPS or real return bond, because that tells you the market is underpricing inflation. So that means the TIPS is underpriced. Conversely, if you think inflation is going to come in lower than the break-even rate, then you're better off in being a nominal plain vanilla bond, because the market is overpriced inflation. So one of the good developments with the ETF market is I consider ETFs basically an access vehicle. It's a capital market vehicle that allows investors to access various parts of the market, not just the equity market, but also the fixed income market as well. So TIPS and real return bonds is a good example of this, where I think if you're trading off your retail desk, it's very hard to get access to TIPS even, right? Or if you do have access, the bid offer spread is going to be exceptionally wide. So with an ETF, not only do you get access to this various parts of the market, but you also get an institutional spread, or even better than an institutional spread as well. So there are a number of ETFs available to investors. There's ZRR, which is our real return bond. We have our short-term TIPS that we launched a couple of years ago as well. The thought process behind that is because we want to focus on the short end of the curve, because as inflation goes up, central banks will counter this by raising rates. So you want to avoid the long end of the curve. That's why we focused on the short end. There's a number of other different products as well. Mackenzie has their Q-tip, which focuses on the entire term. ProShares has the RNIF, which is US listed, and RBC has the XRB, which is the Canadian Real Return Bond ETF.
Thanks, Alfred, and certainly some solutions to help mitigate fixed income as a part of a portfolio, not all of your portfolio, but definitely as a part of a portfolio. Let's shift gears a little bit here, because this is on the fixed income side. Talk to us about what equities can mean to somebody for inflation. And I put a slide up here around that.
Sure. So we did some back testing. Obviously it was hard to find a sustained inflationary period. So what we did was we took the 10-year break even in the US and the daily moves in the 10-year break even. What we did was we basically broke it down to various buckets, broken down by a separation of 10 basis points. So what you'll notice here is that broken down by the various daily moves, most of the occurrences were between negative 10 basis points and flat, and 0 and plus 10 basis points. So the top of the chart highlights what would happen in a deflationary environment. So no surprise, equities would underperform fixed income. Obviously, as you get a deflationary environment, fixed income would benefit in that environment. Gold surprisingly outperformed, and that's because gold typically is a hedge against macroeconomic or geopolitical risk, and in deflationary environment typically there is some geopolitical or macroeconomic risk going on. On the flip side, so if you look at the bottom, that is an inflationary environment. So no surprise, equities outperform, commodities performed well in this environment, bonds obviously underperformed, and surprise, surprise, gold outperformed in that environment, because gold does typically tends to be used as an inflationary hedge as well.
Well, thanks for that insight there, Alfred. And then, so those is kind of the broad market look when you talk about equities, S&P 500, the TSX Cap Composite. Maybe you mentioned here commodities, so maybe let's dive a little bit into kind of the sector side of the marketplace too, is maybe a complement to somebody's portfolio, and give us some thoughts on that.
Sure. So we, talked about ETFs being, essentially an access vehicle into the fixed income market or various parts of the fixed income market. For the equity market, it's no different. So there's a lot of sector ETFs that allow investors to target, various sectors that may outperform during an inflationary environment. So some sectors that typically perform well in an inflationary environment. Obviously, this is, things change over time. Every scenario may be different, but energy may outperform, as we've seen over the last year or so. Infrastructure, because a lot of the projects, they're tied to inflation. REITs, typically in an inflationary environment, unless central banks are hiking aggressively, real estate properties tend to be a good hedge against inflation. And banks, depending on what the central bank is doing, because banks borrow from the overnight window and they lend on the longer term, depending on that spread between the overnight rate and, let's say, a 5-year yield, all things remaining equal, that typically is beneficial for a bank. So these are some sectors that tend to outperform or tend to behave well in an inflationary environment. So there's a number of different ETFs that allow investors to get access to these various sectors, as we outline listed below.
Thanks for that, Alfred. And I'll highlight that, as an ETF provider in this space, we also offer, we're highlighting some of our competitor ETFs and one of our ETFs, but if you're looking to do some analytics in the various ETFs out there, take a look at the tool on our public website. That's bmoetfs.com. You can then do your own homework there and take a look at various different types of ETFs, specifically on the sector side or the broad market side, that may complement your overall portfolio. Thanks for that, Alfred. Now I'm going to bring Charlie into the picture. Charlie, you've been waiting for a while to jump in and give us a special offer. Why don't you jump in right now and talk to us a little bit about InvestorLine, and more specifically, talk to us about the offer. And then I'm going to come back and talk about some questions we got in from the audience.
Absolutely. Thanks very much, Kevin. And thanks, Alfred and Jennifer, following up on the great commentary so far today. I just wanted to introduce myself as the Regional Sales Manager for BMO InvestorLine for Southwestern Ontario and Niagara. And today, for participants, we're pleased to provide 2 very special time-limited promotions for our self-directed platform as well as our advice-directed platform. And participants and viewers can get additional information on our platforms at bmo.com and search online investing. First and foremost, though, on the left part of the slide for the self-directed promotion, clients can enroll using the Invest Smart promotion code when they go online and open up an account, and they'll receive a full $4.95 per trade cost, essentially for the first 90 days of their account opening. There are commission-free ETFs, which we'll get to in a minute, but the promotion code Invest Smart, if you're opening up a self-directed account. On the right-hand side for the Advice Direct platform, new accounts being opened by clients, use the code DIGITAL13 and fund your account with at least $10,000 in new assets. And there's some important dates there. As well, you can potentially get up to $2,500 in cash back on the promotion with Advice Direct.
That's very interesting. But let's, because we have an ETF focused show here, let's hear a little bit more about your ETF offer in the current marketplace. And I know you're running a bunch of ads on this, so give us some insights here, please.
Sure. Yeah. Following up on Alfred talking about ETFs being a great access point and entry point at low cost for investors, we have over 80 commission-free ETFs to trade on BMO InvestorLine. And the full list of them can be found on the BMO InvestorLine website. But as Alfred mentioned, and everyone, the ETF trades allow you to make regular contributions, certainly provide diversification and cost savings over holding stocks, allow clients to make tactical adjustments, and manage overall risk in a cost-effective manner.
I think it's a nice offer, and you're right. It helps make you manage your portfolio a little easier because you're not worried about that trading cost consideration on the purchase or sale of the ETF. And I'll quickly highlight too, you just added some enhanced income ETFs on there too. So not only income, but enhanced income, specifically cover calls. So take a look at that from an audience perspective. And this is a little snapshot. Maybe you can talk to this too, but the types of ETFs you'll find in that 80 and above list of free trading ETFs.
Sure, absolutely. 85 commission-free trade ETFs, and we just wanted to make sure clients know that it's a wide variety and large asset under management ETFs, not just the small ones that nobody purchases. We're using the top 3 providers on the left, BMO ETFs, iShares, and Vanguard. And then, of course, we're going across all 5 asset classes to allow the investor who does want to just dip their toes in a variety of classes. There's a full offering available there.
Perfect, Charlie. And if anybody wants to follow up with you, how can they do that?
Absolutely. There's my contact information, charlie.stanton@bmo.com. Certainly, I'd be open to discussing in more detail the differences between our self-directed and Advice Direct platform. And just a reminder that for participants today, the Invest Smart promo code for new self-directed accounts and Digital 13 promo code for new Advice Direct accounts. And thank you very much, Kevin.
Thanks for that, Charlie. Appreciate you coming on to share the offer. Now I want to shift gears and just jump into some questions that came in from the audience. Of course, the initial topic of inflation came from the audience, so thank you for that. And we encourage you to send your questions in. Let me dive into the first question. Alfred, if I can bring you into this, because of course you run the ZCN ETF for us, which is the TSX Cap Composite. The investor here is taking a look at, please explain why the price of oil has such a dramatic effect on the S&P TSX Cap Composite Index downward slide. Maybe just give some insights there, Alfred, please.
Sure. The TSX is made up of 20% energy. So as oil prices move up and down, that's obviously going to have a pretty detrimental or pretty significant impact on how the overall market moves. But there's also a secondary effect where higher oil prices are going to filter through the economy as well, which indirectly affects other sectors and the economy overall as well.
Thanks for that, Alfred. I got another question coming in here. What are the BMO ETFs run by Brian Belsky? And Brian Belsky, somebody you've probably seen on BNN or one of the various media websites out there. And he also wants to get a little insight of his actual holdings. So first and foremost, the ETF you want to look at on our website is ZACE, Z-A-C-E. And then if you want to take a look at those holdings, you can go to our website. We list the top 10 of his holdings on our website right now. Now let me bring back Jennifer into the questions here, as well as Alfred, because I would like to get your thoughts on how you anticipate the increasing aggressive Fed rate hikes will impact the market both in the short and the long term. Jennifer, please share us your thoughts.
Sure. So we're already seeing the impact of the aggressive Fed rate hikes playing out right now in real time. So we are anticipating a couple more maybe aggressive moves in the near term. They already did their 75 basis point hike in June, and we're anticipating another 75 basis point rate hike in July. That's basically what Fed Chair Powell told us, and I believe him. Of course, there is an increased risk now of a 100 basis point move, just given the big increase in the June CPI and given what we've also seen from the Bank of Canada. Now, interestingly, one of the Fed governors, Waller, who is on the hawkish side, he actually said very recently that his base case scenario is for a 75 basis point rate hike in July, and he will be watching other data very carefully, specifically the housing data and the retail sales data. And if they warrant, then he will probably be voting for a 100 basis point rate hike.
So more to come. Watch this space and keep paying attention to those news and announcements. Absolutely. Hey, Alfred, anything you'd like to add on this, please?
Sorry. So the one thing I would add to Jennifer's answer is that I think, the Fed obviously wants to front load a lot of their interest rate hikes. So the more interest rate hikes they do up front, the intention of that is that over the long run, it's going to be more or less interest rate hikes over the long course.
Oh, yeah. So have maybe some short-term pain, but hopefully it gets it over and done with, right? Pull that Band-Aid off, I guess is what you're really saying. Now that brings us to close today's webinar. Let me thank, Jennifer, Alfred, Charlie for taking time out of their busy schedule to share their insights with this audience. Thank you so much for that. And let me give you a quick little plug for next week's webinar we're going to host. Next week's webinar is the mid-year ETF review and outlook. One of our more popular webinars, certainly giving you insights what's gone on in the ETF market for the first half of the year. Mark Rays will join us from BMO ETFs. He runs and actually is the author of the report. Aaron will be back in the hosting chair, and Graham McKenzie from the TMX will also join us. So hopefully you can join us next week, Friday, 1 o'clock for some further insights, specifically this time on mid-year ETF review and outlook. Cheers.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.